All right, so the 6th week. Things are moving right along. I think the book issues are behind us. Again, at least I'm not seeing it in the emails. I don't know why we went down. But anyway, I'm not going there. But if you're still having problems, let me know. Otherwise, I'll just get. We're not going there. Okay, so personal loans. So this is, if you think about taking a loan like renting money, I mean, renting money is just like, renting a house, renting a car, sometimes it makes sense to do it, sometimes it doesn't. And if it's expensive, then maybe not. But there's a lot of times, at least having access to money through personal loans, it's a good thing to have, obviously, and it can save you money in certain cases, or it can be, financial ruin. One of the things that they're not going to cover in here that I'm going to cover right up front is one of the main reasons to be saving for your retirement account is because you can take loans against that. It is so easy because you're taking a loan from yourself, so there's no real approval process. You have to, work with the mutual fund company, the brokerage, whoever's holding your 401k or IRA or whatever, and you take a loan against it. And it's typically the requirements are the loan total has got to be less than 50 grand, which is fine. And it can't exceed, half of the balance in your account. So if you wanted to take a full 50 grand, you'd need 100 grand in there, but that's about it. And then there's other things you can do, and I'll talk about that when I get to real estate. But just because you have a huge, nest egg out there saving for your retirement doesn't mean you can't utilize it. You can't leverage it, throughout the course of your life. Now, I'm not talking about taking disbursements, withdrawals, whatever you want to call it. Do not do that, because that will involve penalties and involve taxes, involve all kinds of other stuff. But when you're taking a loan from a 401k, which is a tax-deferred retirement account that we'll cover later as well. But anyway, if you're taking a loan from your own stuff and it's earmarked to go right back into that account, you're fine. So and there are no penalties, and the IRS is not even in the transaction. It doesn't affect your taxes in any way. So it's kind of cool. Anyway, so other sources of personal loans then I would start with: commercial banks, savings institutions, credit unions, finance companies. Finance companies, they shouldn't really be included in the group. They're one step away from the, car title loans, the lenders of last resort. There's laws in states called usury, right? Usury is a concept that means that you can't legally charge above a certain interest rate. Well, these guys figure out ways to kind of abuse that and get you paying interest rates that's double, triple digits. So it can be crushing. They also have certain states like Delaware. Obviously, we know the politics involved in Delaware. Delaware is where a lot of corporations are formed because they're very favorable to corporations. You go up against a corporation in Delaware, as an individual, you're probably going to lose. Also, if you want to have a big credit card company, they used to locate them all in Delaware. Now North Dakota's kind of gotten that game. And anyway, they have very lax usury laws. They favor the corporation. And so if you look on your credit card statement, a lot of times you'll find that particular credit card company, they may be a big New York bank, but that credit card division is, got some sort of storefront or whatever in North Dakota or Delaware, so that they've got the protection they want, the anonymity, everything else. Friends, family, great, but obviously there's a lot more baggage to that if things go south. Peer-to-peer lending, kind of a trendy thing, still out there. What happens here is you can consider this too for investing. Let's say you're not looking for a loan, but you're looking for an investment. You'll get these letters. Not that I'm some high wealth individual, but whatever, they're confused. And they send me a bunch of these emails saying, hey, put your money in this, Cabbage, or all these different companies that have sprung up. And what they want me to do is they want me to give some money, basically put money in an account there that they're going to parse up, and they're going to make all these little micro loans out to all their customers. And the concept is being that, these loans individually are high risk, because they're going out to small businesses, and small businesses do have a propensity to fail. But anyway, because they I give them say $1,000 and they make $10 loans out of my $1,000 to 100 different companies. Well, then my risk is somehow spread out and a bit safer. And that's the concept. Peer-to-peer, lending club, Prosper, other stuff. So things change all the time out there. And yeah, $1 billion per year. So anyway, yeah, but you got to give them some money, and then they vet these people. They do all the loans, and you just sit back and hopefully get the profits. But you can be on the other side. You can be the small business that is getting shut down. Banks don't want to loan you any money. Nobody wants to loan you any money. And then all of a sudden you find out that these peer-to-peer guys have come up with a concept that, mitigates the risk for the investor and gives you a loan. So that's how they kind of evolved. Loan is sensible. So again, these are loans for the most part should be the strategy with a loan is that you've got your other money invested and you're doing quite well with it, and rather than cannibalize all those investments, you're just going to get a loan for a short term and keep your other money in that better rate. And so, for example, we're talking personal loans here, but like in real estate, I've told you that I have the means to pay off some mortgages I have outstanding, but when the rate I'm paying is 2.85% or something, I would have no business teaching a personal finance class if I can't manage to get more than 2.85% on my investments. So rather than use free cash or cannibalize other investments to pay off those loans, I'll keep those other loans, that I'm paying a very low interest rate or very low rent, is how I'd characterize it, to control that money, and I'll keep the other money, churning along, maybe doing something else, maybe buying other real estate. I wouldn't, dump it in Bitcoin or something like that that's speculative. We'll get to it eventually, but we're going to talk about investing and we're going to talk about speculation. Two separate things. Speculation is get rich quick schemes that involve a lot of risk. Investing, probably a little bit more boring, but more methodical. So I'm not advocating speculation. So when I talk about crypto, yeah, I don't consider that my investment money. I consider that, my whatever, since I don't have other vices such as, going to Las Vegas or going to the track. At least with crypto, there's a chance I might win. When you go to a casino in Las Vegas, there's pretty much no question that you're going to lose. I mean, somebody's building those casinos, and if you can't figure it out, you shouldn't be there. Anyway, the personal loan process. So, yeah, they may want to see some of these documents, but again, it's going to probably be some drop-down menu. So having the information readily available is good, because then you can just kind of plug it in. But no, they probably won't want your own form. So anyway, loan contract, yep. And you'll see a lot of standardized language. You'll see APR. You'll see very attractive terms, and then you go to sign the thing and you go, wait a minute, because now they have to come out with like these legal statements that show, okay, for this $300,000 home you're buying, at the end of 30 years, you will actually have paid $600,000 for it. And you go, oh God, I don't want to do that. But then you think, wait a minute, $600,000 30 years from now, isn't going to be much. I remember when I was growing up, my parents had a home mortgage of $133 a month for a big, it was not, extravagant, but it was a good 3-4 bedroom home. And I mean, the inflation, things change. So if you're, that's another, if there is a positive thing about inflation, in inflationary times, that money I owe on those home mortgages is being eroded away. They're going to get their money out of me eventually, but it's not going to be worth much. So if there is a silver lining in inflation, that would be it. It benefits people who have money out. Loan repayment schedule, so amortization schedules, and we've kind of seen this where, they tell you principal and interest. And again, it on the short term, these charts aren't that impressive. On the long term, you will see that for the first portion of a loan, you are paying almost exclusively interest and very little principal. And that's just the way they do it. In some places in Europe, they do it differently. I've seen that the French model's a little different, but in the States and most other Western countries, it's very weighted towards the front of the loan where it's almost exclusively interest. Which, let's say your payment's $2,000 a month. It doesn't bug me a bit that it's just about all interest that I'm paying, because that interest is tax deductible. The principal is not. So you'll see people getting, close to paying off their mortgage, and all of a sudden they're like, wow, I like that I've almost got this thing paid off, but I'm not as happy that I don't have this tax write-off I used to have by paying that interest. So maturity, life of the loan, longer. So for I keep wanting to jump to real estate. What we're really talking about here is personal loans, but the longer the maturity equals payments, but more interest payments. So you'll see this game played a lot of times when you go to a car lot. They're like, what do you want your payment to be? That's why I don't buy new cars. I just find those people insulting. I mean, I can do math. I know, I'm going to say I want to spend $500 a month, and they're going to say, oh, great. Well, we'll finance this $80,000 truck over 10 years, and that way you're only paying your $500 a month. Well, guess what? I'm paying that $500 a month for a 10-year-old truck somewhere down the road. And oh, by the way, that truck is probably kind of sort of worn out, so now I'm paying maintenance in addition to that. So don't be conned into that. Do your homework, have some discipline, know what you need, and I would advocate just getting what you need. But if you do go, and whatever, buy something fairly extravagant, make sure you know what you're getting in on, and make sure that, although you're willing to suck up big payments for a brand new vehicle, do you really want to do it 7 years down the road? Probably not. Collateral is what makes, and I discussed this, where the security, if you just get a straight personal loan on your signature, the bank doesn't have collateral. Credit cards are super expensive because they can come after you to a certain extent, but it's difficult. If you do that same, I'm not going to pay my credit card with a car, you'll go out one morning and the car's missing. And you have no recourse, and it's all fair. And believe me, if you're paying your bills, that's what you want. If you see a car dealer that says, we'll finance anybody, that's not the dealership for you. I mean, unless you're truly that desperate. But no, if they're financing everybody, they're financing a bunch of people who flaked out on their loans, and who sucks it up? Who has to pay to, they have to charge higher rates to everybody to, compensate for the whatever. I don't know. Can I say deadbeat? Anyway, the people who aren't paying their loans back. No, I want to go to the people who only lend money to exceptionally, low risk individuals, because they're going to be given the least risk. And so again, if a loan is secured, it's got some collateral, it's got a vehicle, a house, some property, something that they can sue to get that money out of you, that interest rate's going to be lower. And that's great, because you're not planning on flaking out on the loan. Co-signing. Don't do this. Whatever. You may end up doing this, and it may work out, but man, so what happens here is you've got this buddy who, some bad luck situation, and they can't qualify for the loan. Maybe they just don't have the resources to pay for the loan. Anyway, they can't get the loan. So they come to you and they say, hey, will you co-sign with me? And what you do is you actually are on the loan now. So, don't be surprised when your buddy here doesn't pay the loan and the thing goes into default. But you actually are probably going to be a bit surprised, because they probably send the initial late notices to your friend, not to you. And now the thing's in default, maybe in collection, and that's when they finally notify you. And these banks, they could care less about your friend, because your friend, he couldn't qualify for a loan. I mean, time is money. These people only have so many hours in the day to chase down loans, and they're going to go after the person who's got the money. And since you co-signed it, that means you had the money. So, yeah, your friend is literally off the hook here, because they've got a pretty strong argument that, yeah, they should have probably never had this loan. They didn't have the means to pay it back. And so you're probably going to get blindsided. You're probably going to get, and you never even got the benefit of whatever it is you co-signed for, the vehicle or something like that. So, if it's that good a friend, just give them a loan. I mean, that's what you're essentially doing. Take out a loan in your own name. Don't have their name even on it, and just let them make the payments to you, if you feel that strongly about it. But the advantages of co-signing, maybe if it's your parents, that's one thing. But if it's a friend, well, it may not work out. All right, so loan application, we can figure all that out. Yeah, it's just like anything else. And again, this is so generic as to be kind of worthless. APR. So APR is the rate you're looking for. And when you actually get to the contract, there's going to be some language in there that, especially like in a house situation, you should get all those documents a couple, 3 days before. In a, document, you should get that information long enough ahead of time so that you can look through it. So different ways to go. Here's, different interest expenses, some sort of origination fee or some whatever, just extra money for them. And so the interest rates, you have to compare everything through, look at all the expenses, not just, the interest rate. Because if they bundle in a bunch of fees, that's like with home refinancing. Again, there's some fees that need to be recovered that are legitimate. And so if the interest rate drops by, 1/10 of a point, it's not going to be worth it. If it drops by half a point, again, that's when you talk to your mortgage broker and you go, it helps to have a friend who's in that business and say, does it make sense yet or not? And get that done. So this is how you, pay off a loan. This is so it's only a year-long loan. But anyway, the interest is higher in the first couple months and low on that final month. Principal changes. So you can see how that whole thing changes as you go. But on a home loan, it's much more extreme because the period involved. How much you spend on a car. Again, cars are not an investment. Cars are a depreciating asset. Cars are what enables you to get to work or get through life so that you can generate money. But they're a tool, should be. And again, I get it. Everybody maybe wants something nice, but I've always been able to kind of have both through having, older, more classic cars, because to tell you the truth, I'm not a big fan of some of the newer stuff. And so if you know what you're doing, and if it's kind of a hobby, I've not made a ton of money, but I've always made money on the cars I've sold, which obviously on the new car, not going to happen. So preferences, price, condition, insurance, resale value, repair expenses, financing rate, and contracts. So yeah, and I'm not saying to get the cheapest one, especially if it has to do with if you have to buy something as if you're going to be selling it at some point in the future. So I don't think I'm going to shock anybody by saying that, yeah, if you buy a Toyota, the resale on that is substantial as compared to some of the other vehicles that are out there. Maybe those other vehicles will establish a reputation, but right now, it's certainly, I've always had, for a utility car, for a daily driver, I've generally had 4Runners, and those things are just money. I mean, they're somewhere in between an investment and a vehicle, because they generally don't lose money, and they're simple and robust and all that. figuring out resale values, though, Edmunds, Blue Book, nearly worthless. A couple reasons. One, Alaska's a non-disclosure state, so since we don't have sales tax on vehicles, people will, or used vehicles, states like California or whatever, where they're charging individuals, like if you sell your car to your buddy, when you go to re-register, you have to state how much you paid. Now, people generally fib a bit, but anyway, it establishes a government kind of baseline of what those vehicles are worth, and then they'll charge you sales tax. In Alaska, there's not that going on, and then just the market is much smaller up here. And then also, a lot of these companies, Kelley Blue Book and Edmunds and all this stuff, they used to be sort of this third-party group that established prices. And, well, the dealers don't like that. And the dealerships, the manufacturers have got tons and tons of money. So when these guys are valuing their cars, they feel like they should value those cars. So they still maintain their whole third-party appearance, but it's largely an appearance because the dealerships have bought most of these little third-party things that establish the value. It's kind of like the J.D. Power version of equality. You can, maybe I'm besmirching those guys, but a lot of times you can buy awards. You can get that done. You can finance a study to figure out whatever results you want. So. Like everything else, there's some corruption involved. Repair expenses, certainly. I've got a couple Mercedes right now that are out laying in my yard because they literally are not worth the money to fix them for silly reasons. So yeah, I'm not going to spend a lot of time on this. But yeah, Kelley Blue Book and Edmunds and the rest of them, not great. But forecasting resale value is tough to do, but I think we all know there are certain brands that hold up in certain styles. I've always found, at least in terms of performance and luxury, performance definitely holds up, and luxury, just there's not a lot of status to having a 10-year-old Cadillac Escalade, but there is some status to having a I guess 20-year-old, 30-year-old Dodge Viper at this point. At one point, I was looking at buying a Dodge Viper or a Jaguar XKR, and they were both, fairly high performance, but the Jaguar was all leather seats and all the amenities, whereas the Viper didn't even have windows. The roof was whatever. Everything was lightweight, and looking at the values after I sold the Viper, the Viper went up a fair amount in value, and the Jaguars at least halved because the luxury just compared to performance didn't seem like it stabilized. But anyway, unique situation doesn't apply to most of you. But anyway, look at the costs involved and the insurance costs. Again, not to make this the Dodge Viper thing, but the Viper was uninsurable basically because it was too much horsepower, too many idiots own that vehicle, and just everything about it. And I had it in Europe, and they had 43 different categories in terms of vehicle insurance, and the Viper was in the highest category. I essentially, to pay the insurance on it, I could have bought a new Viper every other year. The vehicle cost on it was going to be like $17,000 a year to get full coverage. So I went with strictly liability and was careful, and it paid off. I didn't crash it, but yeah, if I would have crashed it, it would have been a total loss. So not a good idea for a daily driver, which it was not. Okay, negotiating the price. Yeah, this is just, you see these dealers, oh, don't worry, we're just one price. We don't haggle. We take all the stress out of it. Well, you don't come down on your price. Anyway, in some of the most desirable cars, Subarus and other things, where they won't even sell from state to state because I just don't like the new car buying experience. So for a lot of you'll see some trucks coming up from, different dealers in Idaho or other places, and if you're going to make that larger purchase and you don't mind the drive, may be a way for you to get around, some of the local dealers, but up to you. But you definitely need to shop around and figure out what things are, and have an idea of what if you're trading in a vehicle. I know it's a hassle, but you're probably better off selling it outright, because the dealer is not going to typically give you the correct price. They may give you a lot for it, but then not budge at all on the sales price. They play the number in the middle. So sometimes they'll discount the car and then give you nothing for the trade-in, or they'll give you a ton for the trade-in and then not sticker at all in the sticker price. They're just concerned with that amount in the middle. Financing decisions, yep. And this can go even longer. When I was in Spain, people were taking out home mortgages for 60 years. Yikes. Yep. And vehicles, sometimes, especially if you drive them hard, may not be worth a whole lot. So here's, some sample numbers. You can go for 3 years, 4 years, 5 years. Obviously, due to the cost of vehicles, the 4 years probably more normal than 3 at this point. But and it seems like, I don't know whether it's willingly, but people seem to drive a lot more. Used to be 100,000 miles and a car was considered worn out. Now a lot of times, obviously, we go way beyond that. And so it does make a change by stretching out the periods, even at the same interest rate. Leasing doesn't make sense for most people. Again, it's very popular with BMW and Mercedes and some of those marks because their sticker price is high and they can come up with a way to get you in, but you're essentially in a long-term rental. If you put a bunch of miles on the car, get a bunch of dents in the car, when they get their car back, because it is their car, they're going to charge you for it. There are some situations where if you've got a business, but I've never even found them in the businesses I've had. But for a personal person, for an individual to financially benefit from a lease, typically not. So no equity, yeah. You still do the maintenance and then additional charges. Student loans. So student loans, what you need to do is, obviously you need to go get through school, especially since you've started. And, suck it up to a certain bit. You need to, invest in yourself, but you need to take out as little as possible, as little as you can get by with. What's happening is, until you get your student loans paid off, it kind of prohibits you from investing. So all those charts we talked about, investing for your retirement and investing in a house and all that stuff, it's hard to do when you still have a bunch of loans out there. Plus you end up maybe in a job you don't like. I've got a daughter who's going to be a doctor, and she worked for a number of doctors, and the number of doctors that are just hopelessly depressed because they've got huge loans and they don't like what they're doing. Not good. They're sort of job locked. Well, not sort of, they are. So now if you're going into a profession that might have a loan forgiveness option, if you're going to go teach in rural area, or you're going to work for some entity that's known for, but again, just explore those options, but try not to go nuts on the student loan debt, or it'll be held over you. Again, we talked about the politics involved in student loans, of how they're now used to try to manipulate people to get them to vote the correct way, and we'll see what comes of that. It's going to be an election year, so expect some proposals on that again. Home equity loans. This is a loan where you need cash and you're taking a loan against your home, so the collateral is there, so the interest rate is going to be lower. Technically, it's supposed to be used for the home improvement, but if it frees up other money that you can go buy your boat with, or whatever it is you wanted, that's legit. You're just going to have to show that there were maybe some improvements done in the house that would justify that loan. So But again, this assumes you have a home and it assumes you have some equity. Equity would be, I paid $300,000 for the home and I paid the loan down to $280,000, so now I got $20,000 in equity. And oh, by the way, the home now appreciates for say $320,000, so now I've got $40,000 in equity. So you can start, as that equity grows, you have more options. And the economy, obviously. But anyway, you have to get an appraisal. You see what your house is worth. It could be done. Interest rate. Yeah, they're saying typically variable in a home interest rate. I don't know that I wouldn't really be opposed to taking a variable interest rate just because rates are so high right now. If you take a variable rate loan, it's going to be lower, and the notion would be that as long as you have the resources to refinance, you can trade it in for a fixed. But hopefully the interest rates will drop, and that's when you're going to switch to a fixed. But another reason people do it is for the tax deductibility of the interest paid. Payday loan, things have gone horribly wrong. Your plan did not work out. You're down there. You're taking out a loan on your. And other things, there's some other subtle loans that are out there, like when they say, "Oh, instant refund on your taxes." There's no such thing. The IRS does not work in that method. What they're doing is, whoever prepared your taxes, they calculate how much your return is, and then they loan you the money, and you sign over the refund check to them. And oh, by the way, there's some fees and some interest built into that. So if you're that, desperate for that money and you want to take a loan for it, that's fine, but know what you're doing. It's not an instant refund. And they may get into these situations with payday loans or different. These guys are malleable, People will object and call all these loans predatory, and then politicians will, change the laws to eliminate some of these lenders, but they're probably in cahoots with the lenders, so they'll leave a nice loophole that allows them to, oh no, we don't do payday loans, we do, signature loans, or we do vehicle title loans, or whatever the flavor of the week is, and they'll always be out there. So, Chapter 10. So I keep alluding to financing a home. I'll spend more time on this in a kind of a extra session when we get to the end of the term, when we get beyond sort of the testable material. But this is a loan for a positive purchase. This is, and the other loans are not bad. To take a personal loan, if you're doing it for the right reasons and not to finance the fact that you can't live within your budget. If you're doing it for positive reasons to potentially make some money on an investment or purchase something like a vehicle and take advantage of a low rate and all the rest of that, there's legitimate reasons for personal loans. But in home loans, this is just about all positive. How much can you afford? Well, you don't have to necessarily ask all these questions. What you need to do is you need to pick a lender, and you need to go get a pre-approval letter. So you're going to go in there, probably spend $50, probably $75 now, whatever. You need to get a credit report, but that's going to be the only charge. You haven't committed to the loan, so the loan company is not going to suck that one up. They'll make you pay for that part of it. But the pre-approval letter, they'll generate for you and do all that stuff because you're in the market to buy a home and they want to be your lender. So they'll tell you what you'll need, and there may be special cases. You may be a veteran and you might be able to get a VA loan. There may be something else, but typically 10 to 20% is what you need. And what you're normally looking at is fixed rate 30 years. Fixed rate as opposed to like variable adjustable rate, meaning the interest rate and the payment will stay the same for the entire term. In 30 years, that's just the standard. You can do, I want to get it done in 15. Fair enough. Get a 30 and pay it in 15. There's nothing wrong with that. If you get a 15 and you want to stretch it to 30, now you're in default. So don't do that. I mean, again, personal preference. There are 15-year products. There are other year products. I took a loan in Germany, And because I sold another home in Spain for a fair amount of money, I put down a huge down payment and just went with a 10-year mortgage because I knew that's about how much longer I wanted to be working. And it was an investment loan, really, not so much a home loan. I mean, I took it as a home loan because that's the only way you get a good rate. So as long as we're there, let me just speak to that real quick. What happens if you say, okay, I'm doing well, I own a home, I now want some investment property. I'm going to go to the mortgage lender and get a loan to buy some investment property. Expect that loan to be high. There's no incentives, there's no government programs, and there's just a higher propensity for people to flake out in business investment situations than it is with a home they're actually living in. So when you go to get a loan for owner occupied, that's where you're going to get the lower interest rate. So a good strategy would be to look at your first home as a future rental, So, and it always makes sense to look at something as if you're getting ready to sell it. So let's say you love this house, but the schools are garbage, but hey, I don't have kids, so who cares? Yeah, you do kind of care because it's going to affect the resale value because the potential buyers will probably have kids, and it's going to affect the rental value because they'll probably have kids too. So you want to buy, a good, well-rounded house and find it. But anyway, so you get this sort of starter home. You live in it for a couple, 3 years. You got that good loan rate, and now you move on to the home that, is more appropriate, the one you like that you can now afford. But you keep that old home, and now you've got a rental property, and you've got a great rental property because you don't have to change your loan or anything. Let's say you had a 3% loan on a rental property, you're probably going to do quite well. I mean, you're going to have to deal with toilets and tenants and all the other stuff that goes along with having tenants. But if you're looking at investment property, one that you previously lived in and had a great mortgage rate on, that's what you want. And so if you live in a home 3 to 5 years and then move on and move on and move on, next thing you know, you've got a collection of rental properties, and oh, by the way, you got a super nice home. And there's a thing with capital gains. Let's say you buy the home for $285 and you sell it for $385. If you lived in it 3 out of the past 5 years and a few other caveats, you get to keep all that capital gains. It's not taxed. It's just a perk of real estate that's in the tax code. So it's one of the few investments you can get that's tax-free again. So lots of good reasons to do that. Okay, so moving back on, 10 to 20%, 30 years, 2.5. Yeah, they come up with all these formulas. It depends. If you're living in, say, San Francisco or New York or something, good luck. Real estate is so high in other areas. Not that those are, say, desirable areas, but let's say someplace in, I don't know, Miami or Arizona or something where real estate is volatile and going up and up. Who knows? These rules need to be sort of regionalized. In Alaska, hopefully you can conform to that. But your lender is going to be the one who's going to decide what kind of risk the banks will tolerate. You don't necessarily get to decide. You get a vote, but even if you want to get very aggressive and take out a massive loan, that may not be available to you. Affordable down payment. Yep. So you're going to have some closing costs in there. You as the buyer, though, do not pay the commission, which is one of the huge costs. So 6%, that's what the seller's got to suck up. And you see a lot of times, even in Alaska, due to the high propensity of military people, you'll see, home prices go up by at least 6% every 3 years because it's all the, people in the military who are here for typically a 3-year tour. They buy a home and they sell it, and they don't want to lose money, so they at least want to cover what they had to pay to the commission to the salesperson, so they'll up the price by 6%. And Anyway, affordable monthly payments. Yeah, look at your cash flows, see what you can do. Allow for continued savings. Your savings may be in your real estate at that point, which, looking at the rest of the market, maybe not a bad thing. Don't go for the maximum forward. Don't buy above. I wish they had these rules in the vehicle stuff. They don't seem to talk about this. They don't tell you that, don't buy a huge vehicle. Don't do any of that. And they could just put values drop and will continue to drop. And anyway. But if you're going to be in debt, real estate's my preferred debt. Purchasing a home. Yep. Huge thing. But quite secure. Everybody's got to live somewhere. It depends on the market again. If you're down speculating in Miami or Arizona or, some of those places, it can be a very risky situation. But residential real estate, for the most part, is pretty safe. Compare the cost of buying versus renting. Consider a condominium. A couple things to say there. Number one, let's say you do this cost analysis. You say, okay, it's to buy a home, it's going to cost me $1,800 a month, and to rent a home, it's going to cost me $1,800 a month. So I think I'll still rent. Well, that's a snapshot. Now there are a lot more little hidden costs in buying a home, because now all of a sudden you're buying garden hoses and you're putting in fences and you're doing stuff that just sort of creeps in there. But you may be enjoying it more. Anyway, but the deal with, as we talked about in the loans, let's say that $1,800 mortgage, that's it forever. There is no inflation on that $1,800. It stays $1,800. Whereas that rent is tied to inflation. And there's the other aspects of it where you're still paying, even if you're renting, you're paying the property tax. I mean, the landlord's paying it for you, but you're essentially giving him the money and then he's writing it off. So just the tax benefits. Consider a condominium. I'm very negative on condominiums. The whole reason I live, whatever, it's space is a great thing, but the problem I have specifically with buying a condominium is I saw this in the limited exposure I had selling real estate. Most condominium associations have maximum numbers of rentals that they'll allow within their condominium development, and I don't like giving up that kind of freedom. And then you also have sort of a homeowners association on steroids, being in the condominium and whatever. But getting back to the rental issue, what I don't like about this is, let's say you own a condominium and now you're going to move and you need to sell this home, or you need to sell for one reason or another, and the market's crummy, nobody's buying, so you say, okay, I'm just going to rent it instead. Well, you may not be able to rent it because that particular development might already have the maximum number of rentals. So now I'm stuck. I'm having to keep this thing on the market, maybe lower the price. I just don't like that, having my hands tied like that. If I own a small home of equivalent value to a condominium, I can rent it if I want. I can sell it if I want. I can do whatever I want. So for me, a lot of these things are no-brainer just because of the number of animals I've got. But for others, definitely, if you're going to do the condominium, what you own in a condominium is you own everything from the paint inside. So you don't own the building itself. You don't own any of the area. You just own, the carpet and the paint and all the appliances and all that other stuff. That's all you. But the other parts of the structure are not. Relying on a real estate agent, it's a no-brainer when you're buying. I'm not saying this, I'm not shilling for these guys, but there's in Alaska especially, post-earthquake, the disclosures, the the fact that, I've seen a number of things on the for sale by owner type thing that should be shocking. Um, you know, Avalanche zones and shoddy construction, and a lot of those people may have tried to sell it through an agent, but the agent won't take it. And I probably, I don't know, half dozen transactions where somebody wants to list a home. They call me up. I go out there, I look at the home, and they tell me what they think it's worth, and it's astronomically high. You're like, no, I'm not going to list it. I can't list it because it won't sell. They're like, then they get insulted and they say, okay, I'm going to sell it myself. And so you'll find a lot of times on the for sale by owner market that much of the stuff is overpriced, or they're putting it on there because they don't want to pay the commission, but they're, avoiding that 6% charge, but do they want to share that with you? Or just other things. Some of the inspections I've seen that are also not done. You don't necessarily find them till the next transaction. I've sold a home, and it was when went to sell it, find out it had all these problems, and it's like, but we've only had it 2 years and it was fine. Turns out all those problems were there before this person bought the home, but it was because it was for sale by owner. Nobody had looked at it, and the well was non-functioning. Basically, everything was just a mess, and it didn't show up until those people actually tried to sell it. And me, as the agent, the salesperson who's going to be involved in this transaction, if I don't disclose all that to the new buyers, I get sued. So anyway, just for the most part, you could still find maybe a for sale by owner if it's a property that you know of already, but to go into the market and not use an agent, it, again, as the buyer, it doesn't cost you anything. Criteria, I'm big on location. Location is what it is. Also, location, especially, again, some of you may live on the other side of Wasilla. For me, that would be a showstopper. I'd rather drive through Anchorage than Wasilla. It's just brutal. But anyway, some of you may be distant, not realize what I'm talking about, but that commute from the valley can be a big factor for some people. But location, where's the property located, how it compares to the rest of the neighborhood. You don't want the most expensive home in the neighborhood, but you don't want the lowest one in the neighborhood. Although given a choice, I'd probably take the lower value one because it's going to be boosted up by the neighbors. Also, the homeowners association. See what the track record is. I had a friend who was he was their homeowners association rep, and he was nothing but a tree counter. He would go around in the middle of winter, and these people need to have 3 living trees in your yard. And if a moose came by and happened to gobble up one, well, you need to get another tree in there or face their wrath and penalties. No trailers in the front yard, none of this. I mean, it can be a good thing, bad thing, but again, I'd rather live out in the sticks and have some land, but personal decision. Market analysis. Yeah, lazy realtors use this price per square foot, which in a subdivision might be fine, but if there's land involved, it frustrates me. When you talk to somebody, you say, "What's your house worth?" and they say, "Well, real estate and whatever, Eagle River is worth $1.85 a square foot." Well, so some dog on whatever, some nasty subdivision is worth the same amount as a home on 5 acres. What about the land? What about the location? What about so I don't like that. And can be obtained from real estate broker or appraiser. Well, if that's all they're going to use, what you really want to use are comparable sales. So it takes a little bit of time. An appraiser will charge. They'll be part of the process. Now they're always going to not always, but 99% of the time, are going to come up with magically just what you offered. So it's not such a check on that you're getting it for a good price. If it's gross, they do have to say something, but they'll usually achieve the number you're looking for. But what they'll look for are comparable sales in the area. So homes that are on the same amount of land, that are in a similar, built in the same time frame, and things that are comparable. It can be easy to get comps if you're in a subdivision. It can be difficult to get comps if you're trying to buy anything that's unique with land and the rest of that. So yeah, again, price per square footage, which, whatever. Don't even want to talk to those people. Obviously, can change. So this is interesting, as interest rates go up, home prices tend to maybe go down. They should go down in the sane world, but that's because there's fewer people in the market. As interest rates go down, prices tend to go up because there's more people who can get out of their rental situation. And so that's what they're showing here. They're showing strong economy, weak economy, but I would almost tie this to interest rates. Low interest rates, confident, they actually qualify. They get a letter saying they can afford this payment, and with a lower interest rate, that amount matches what they have. So prices can go up, and the same prices can go down. So theoretically, not that prices are low right now, but if you bought a home now and with the intention of refinancing it once interest rates normalize, which hopefully they'll do, but again, kind of a gut check, you might be able to get a better price. But I haven't really seen prices go down, which as a homeowner I'm not complaining about. So mortgage defaults, all this other stuff, housing crisis. What they did back then was, this is kind of similar to the peer-to-peer lending thing that I talked about. There's a movie, what was it? The Big Short, maybe, and a couple movies that have kind of gone through this fairly well. Where what they did was, there was real estate had always been such a great investment that there was a feeling that you just couldn't lose in real estate, that it was safe to loan money in almost any amount for real estate because values are going up. And so there were some people who were speculating, took out, multiple loans and, whatever. People who had 5 loans and they weren't even making payments. They were people that they call ninjas. No income, no job, no assets, and they're still getting loans because real estate was looked upon as just being such a great investment that you couldn't lose. And if you dug deep, if you're going to invest in those bonds that held those mortgages, you would probably look at those underlying, people who had all these loans and go, wait a minute, this is kind of scary. But that didn't happen. What they did was they got all of those loans that were fairly risky because these people had no asset, no job, no anything, and they had multiple loans. But anyway, they lumped them all together, and they got all these crummy loans that were kind of crap, and they put all these loans together in a bigger pile, and rather than recognizing that they just now had a bigger pile of crap, they said, oh, no, because we've got all these people involved, and because the underlying assets are kind of disguised, since we've kind of put them in a big pile, all of a sudden that's a good investment. And that's a CDO, or they had all these different names for them, but collateralized debt obligation or mortgage obligations. Anyway, and once it was seen that, there's a problem in the real estate market, that some of these mortgages aren't as secure as they once appeared, things began to fall apart. And that's when they did the examination they should have done
and they realized, uh-oh, all this stuff is garbage. These people have no means of paying these things back. All these homes are going to go vacant. And anyway, the wheels came off the bus. And so that happened in 2007, 2008. And so, yeah, they came out with all these laws to fix it because, anyway, it was greed that brought it upon, and greed will make it return. There'll be another sort of situation like this, but, you know, that scam, they probably won't do that again for at least another 10, 20 years. But, you know, there's plenty of politicians who need to make home loans more affordable, and we need to give loans to people who can't afford them, and there you go. So it's going to happen again, but a lot of procedures were changed, and all they did was really make the application process a lot more lengthy. But again, since people need to live, they'll have short memories and probably return. So, business activities, zoning laws, yeah. So again, this is where having an agent may help out. And again, my only answer to this is by having more land. I don't really care what my neighbor does. In fact, I know what he does. He shoots guns continually. But that's the Butte, and that's the way they are out here, and I don't mind it a bit because it kind of keeps that whatever. It means whatever I'm doing, dogs barking, animals on the loose, it's minor because it's just a blip compared to the rest of the neighborhood. But not for everybody. Second opinion on evaluation, yep. So yeah, you need to have a agent you can trust. There's very few, you know, as I said, there's a small percentage of real estate people who do just about all the business, and that's the person you want. You don't want the one person who's doing it as a hobby. You want the person who's done this before and knows the tricks that are played. Negotiating a price, everything you do. I mean, when I bought this particular property, every property I've ever bought, I've never been in a situation where I guess I've just been fortunate not to buy during some of those markets, but I would never pay, above list. And I've always offered, counter-offered, gone back and forth, and it's kind of nerve-wracking, but it gets it done. Me as a seller, if homes are going for more than list price, why would I not raise my list price? Knowing especially that the appraisal process is kind of a joke, that if I sell it for that, I'll probably get the appraisal for that. So anyway, I never understood that. Down payment, we talked about that. Different agencies involved. You're going to look at the best option you have available. PMI, I did this once. Wasn't a bad deal. It was a military type thing, and it was VA back then hadn't quite caught up, and so the home we were looking at didn't even qualify for VA because it cost too much money. And because I couldn't put down the full 20%, but I still wanted to get a home, I offered, to pay the PMI, the private mortgage insurance. And it was expensive. It was an extra, I think, $180 a month, but I only paid it for like 2 months because the market was going nuts. And so bought the home, paid the PMI, and then ordered an appraisal. The home appraised for, considerably more than I paid for it. And so I was able to show the equity, which equated to now more than 20%. So I was no longer required PMI. So sometimes it works out. But for other times it may just be, I wouldn't want to pay this year after year. But closing costs, so the loan application fee, yeah, that's going to be on you as the buyer. Points, kind of a strange thing where you can buy down the interest rate. Typically not done, but that's what they're talking about. If you're wanting to buy points for a certain, now when interest rates are stupid, I could buy a 7% loan down to 6.5 for whatever number of thousands. I don't think I would do it right now because I want to dump that loan anyway as soon as possible. As soon as rates come down, I'm refinancing, appraisal fees. Anyway, there's all these little nickel and dime things, and next thing you know, you've got about $10,000 in closing costs. Kind of a drag, but that's just the way it works. Because there's well and septic testing if that's going to be done. There's home inspections. There's little stuff, and it all adds up. And especially if you're the seller, there's that 6%. That 6% is not a by law kind of thing. It can't be. It's as close as you can get to corruption as without actually breaking the law. They can't insist upon 6%, but you'll generally sign a contract for 6%, or else they won't do business with you. To say they're all in collusion together would be truthful, but not legally enforceable. So anyway, 6%. Fixed rate mortgage, doesn't change. Preferred when interest rates are expected to rise. Certainly, yeah. Back when they had loans at 2.85, I no way wanted a variable interest rate, even though it would have been down probably 1% or 2%. No, I want to lock that rate in, knowing that that's not going to last. Maybe assumable. Assumable means you can pass it on. Probably not. Most of those contracts are written to where loans are not assumable. Amortization table, this is how it shows you where the breakdown is, and it makes a difference for taxes and stuff. So here, now we're looking at a more realistic time frame. So this first month, let's say your total payment is $537. Principal, that means the part that's actually going to pay the note is $120 of that. The interest, though, is $417. So out of your $537, $400 something is going just to pay interest. Now you look at the $360. This is a 30-year mortgage, so the final year of 30 years out, payment's still exactly the same, but now it's almost entirely principal. Only $3 is going to pay interest. Only $3 is tax deductible. Yep, we know all this. Larger rates, larger money. So another one of these. Boom. So principal over the year, principal over, so that's why the numbers are slightly different. Just in case you want to see it visually. I've known people, again, people, it's personal finance, so people make personal decisions, but, people will change things up, at the 15-year point so that they can get this interest back up there. And maybe it makes sense, maybe it doesn't. Yep. So again, you can take these things out. I don't think legally you can do it in the States for 60 years, but in Europe it was becoming a thing. Real estate in Spain was stupid. I bought a home there, and they said the home valuations were going up by, I think, 17% a year. So I figured out what I paid for this home, and I'd been there 3 years, so I multiplied that, and so I came up with, that's damn near 50%. Actually, it was 50. Anyway, whatever that number was, I added that on and sold the house in 4 days. I mean, and got out of there. And then a couple years later, they had a crash and so it's all in the timing. But sometimes you here's another one: mortgage payments, different mortgage amounts. So this is why you need to do that pre-qualification letter to figure out what it is you qualify for, and so you can get that better agent, so you can go into this process knowing what you can afford. Monthly, so there is some advantages to using the websites, because a lot of times they will have, almost always will have, the interest portion, but they'll have the taxes and the property insurance also in that calculation. So let's say you have a mortgage that's like $1,100, but in actuality it's probably gonna be maybe 13 and a half or so when you figure in property taxes and insurance. And most of the time the lenders will want that rolled into the mortgage because they don't trust you. They want, since it's their home, their asset, they want to make sure that the taxes are paid and that it's properly insured. Could go to bank rate. Could go to a lot of things. We can look at that, but there's pretty good calculators out there. So back in the 4%, yep, 30 versus the 15. So 15 is going to be a little bit more, but you're going to get paid off twice as quick. But as long as there's no prepayment penalties, you can get the, whatever rate and say, okay, I'm going to take the 30-year mortgage, but I'm going to pay $956 every month instead of the $734. And guess what? Your home's paid off in 15 years. And if you get laid off or something, you say, ooh, I'm just going to pay $734 for a while till things get back on track. And then you jump back and pay the higher. Anyway, I like 30 years, especially if I'm getting a good rate on it. Different people have different opinions. But 30-year is fixed rate is the standard. ARMs, definitely gut check. What they do here is, let's say interest rates right now are 7. We'll see what an ARM's going for. I'll look on that on bank rate here when we finish. But let's say it's at least a couple percent lower. So it may be the only way that you can afford to get in this house. Now, if inflation goes up, your interest rate's going to go up. It's going to be indexed, and it's usually going to have a cap. Maybe it can go up by 1% per year, and it's going to be tied to some recognized index. So the federal funds rate or the London interbank, whatever, LIBOR rate. Anyway, it'll be tied to some rate, and that interest rate and your payment can go up. But in the meantime, you're paying a lower interest rate by exposure to that risk. So initial rate usually lower. The index may make it go up or down. And I have done this before, but I used it as more of, actually now that my German mortgage, I kept it the entire time. And I was paying, 3% when everybody else on the fixed world was paying 5%, and it worked out great. But yeah, was I exposed to a little bit of risk? Yes. Could I have compensated for it if I guessed wrong and interest rates went up? Yeah, I would have had to make up that. And it would have been not as nice. But there's usually a cap. Well, there's got to be a cap. You just got to read the fine print to figure out what that cap is. So, anyway, talk to your mortgage broker. And that's, again, don't just get, my opinion, your friend's opinion. Do a little research, do your due diligence, and ultimately the lender is going to decide. If the lender thinks you're really putting a lot at risk, they're not going to loan you the money. But if they're comfortable, you're comfortable, might be a way to get into the market. Home versus rent. So again, I see home ownership is an extremely positive thing in terms of investing, especially when your other investment alternatives, stock market and other stuff sometimes are a little bit more volatile. I'll go through kind of a quick scenario here. Let's say you want to buy a home. There's a concept called leveraging that we'll talk about in investing. Leveraging means using borrowed money for investments. So if you buy stocks on margin or crypto on margin, you are leveraging. Is that smart? Probably not. That is definitely in the speculation realm because you're borrowing money on a volatile asset. Now, borrowing money on a home, not frowned upon necessarily. That's just the way things are done. So let's say I'm going to invest some money in a home. So I need 10% down. I'm buying a $300,000 home. So I invest, 30 grand into this home for that down payment, and now I'm controlling a $300,000 asset, and I keep, let's say the home is going up, the value of that home is going up by maybe 3% per year. So at 3%, I'm making $9,000. That's how much my net worth is going up every year by that $300,000 asset going up. So although I only have $30,000 invested, I generated $9,000 worth of, 30,000 invested and $9,000 worth of net worth was increased. Now, there's other things involved. Yeah, I am paying rent on that money, so depending on the interest rate, that could wipe that out. Also, money I'm making, if I don't live in that house, they're going to take the capital gains. But just the same, that ability to use a certain amount of money to control a larger amount of money, that leveraging concept is even though interest rates in terms of appreciation of real estate may be not that great, it does add up over time. And if the market's exploding, now you're in more of a sketchy market, you're speculating now or on the verge of it, but man, the gains can be crazy. You can make a lot of money in real estate, and certain people do, and certain people lose quite a bit. But compared to crypto and the stock market, it's kind of a no-brainer in my mind. But anyway, what you're going to lose by owning is you're going to lose mobility. Job opportunity comes up someplace else. It's not quite as easy. You got to sell that home. It's not a liquid asset. You've got other costs involved, but for me, I want no part of renting. But anyway, special types of mortgages. There will be some creative mortgage that will emerge. Some of these got flushed out after the housing crisis, where people essentially had no payments. They pay nothing, and then all of a sudden they've got some huge payment that's going to show up in 5 years, but they're speculating on the home. They're going to sell it in 3 years, so they never ever paid anything on it. And anyway, it was just kind of smoke and mirrors, and a lot of those riskier schemes have kind of gone away. Interest-only mortgage, yeah, that was popular back in the day, but now most lenders are not as comfortable. Refinancing. So rates need to change a bit, maybe 0.5%, maybe 1%. You need to talk to your lender to find out what those additional fees are. But yeah, refinancing is how it's done. I've refinanced a couple loans a couple years ago when they hit kind of rock bottom, and both of them, it was 1% or 1.5% that I got it down, and I didn't necessarily have crummy mortgages. I mean, my loan rates were only in the 4s, but when you can take them down below 3, it was kind of a no-brainer. And now they're locked in for the life of the mortgage. So, got to look at the costs though, and got to have somebody you can trust, because the lender, they get a little commission, they get some fees, they get some other stuff, so they're typically going to be leaning forward trying to get you to refinance. You got to have somebody who you can trust, who can do an analysis and say, yeah, no, it doesn't make sense right now, and not go for the quick money and get you on this one deal. My lender friend, I'll continue to do business with him because he hasn't burned me. If he burned me once, that'd be the end of it. So you want somebody who's in it for the long haul. All right, let's check something out here. So when we're doing this term project, which you all know you're going to have to do at some point, but part of it, you may kind of delve into some of these calculators, and one of them might be, bankrate.com. The other place is on the mutual fund sites. You're going to see a lot of stuff. But here, we're going to look at, well, they've got a lot of things you might be looking at, but these guys are going to be heavy on advertising, right? That's where they make their money. And purchase price $670. Whew. So they're looking at rates. See how there's this rate? Okay. Until they say APR, it's kind of meaningless. APR is the number. Now, see this one, 6.625, and it's an ARM, adjustable rate mortgage. So, given a choice between 6.75 fixed and 6.625, there is no way in, I don't want to cuss, but no way in hell I'm taking exposure as your risk for that little break on the. I mean, they gotta throw me a bone here. This has got to come down by a couple percent. And now, even when you look at the APR, so nobody's taking this loan. I don't know. I mean, it's the leader because it has this sort of teaser rate to get your attention, but you're going to end up with a worse situation. So anyway, and they're looking at points. So this is these rates are just not good. So I don't know where that zip code is. I think they think I'm in Seattle, probably based upon the IP. And maybe that's why they're putting in this high price. And they want to know what's out there. So 30-year fixed, 20-year fixed, 10-year fixed. You could do all that. Let's look at some of the other options. Here's all these ARMs, adjustable rate mortgages. So if you're taking an ARM, you're taking a little bit more risk. You need to be compensated. That rate they had there was not enough compensation. FHA, knowing whether you qualify for it. VA, if you qualify for it. Interest rates, mortgage rates. So a lot of information, again, not stupid tabular data, actual charts that you can look at. And you can see, I can save almost a whole percent by going just 10 years. Because the way these mortgage people look at it, they're obligating their funds for less risk based upon less time, less volatility, even though 15 years is a long time. More stuff on here. So some kind of cool stuff. And they'll give you, let's look at some more information. Now again, these guys are a .com. They're not necessarily your friend. They're trying to make money. They're trying to push you, but they will put some information in here that might help you out a little bit. Let's look at one more thing since we're on. I mentioned the term paper. Again, it's tailored to your own needs. So look at the description in the syllabus. But in terms of building your term paper, don't get overwhelmed. Just look at this stuff and kind of go through and see the things that you need to address, for your term paper. Not everybody wants kids, but if you're going to invest money for your children's education, you should be using one of these plans if you want to get a decent grade on your term paper and if you want to have a decent return for your child. So 529, TUGMAs, UGMAs. Anyway, these things are, what the gist of these things is that you invest money for your child, and as long as that money invested is used for educational purposes, the money is tax-free. Now, if you use it for something else, you have to pay taxes on it and probably a little bit of a penalty. So, if your kid ends up not going to school or you end up not having kids, but these are probably something you do when you actually have a child. But anyway, if you invest, say, $100,000 in here and it grows into $500,000. We're looking at higher amounts, but maybe that's what college will cost in the future. But anyway, yeah, your child, because you invested in that tax deferred program, will get, or tax advantage program will get that full benefit. If you invested it in another program and you just gave your child that money, they're going to get quite a bit less because all that money is going to be subject to taxes. So there's neat things in here. There's how to build your wealth. Not a big fan of, but retirement stuff. I'm saving for retirement, which even though you're not like this lady in the picture, you should be thinking about it. You need to get started. All these questions about how much you need to do, how much you need to have, calculators. You type in some numbers here. You take a quick little screenshot. Whoops, that's a different thing I was working on. And boom, you can have a something to add to your paper to give it some meat, some reference. So a lot of things buried in here that would be kind of useful. Don't make your paper nothing but just a bunch of images, but if it's tied together with a narrative, that's perfectly fine. And if it's useful to you, then you should get a good grade. That's my criteria. Is it useful, to what you're doing? So again, the one final thing that I'll probably have to say over and over again is what you're looking for is in the paper. It says, fast forward yourself to about 5 years ahead. Put somebody in a very similar situation. The reason why you're using like 5 years ahead is because by that point you're probably immersed in your career and you're making enough money to, be doing those sorts of investments. If you're just a part-time student, you've already got a career going, well, then that might not apply to you. Just do it from now. And anyway, what you're looking for is a realistic plan of how you're going to get ahead. So, all right, that's probably enough. We'll call it good. Oof, hour 20, too long. Talk to you next week.